Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of orats, an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to be scanning for earnings trades using some of ORAT's proprietary indicators. Matt, do you want to share a screen and get us started by going over our trades from last week?
Sure. So we have Iron Condor that is, still going about break even right now. And then we had Ulta and we had Baidu on. So sorry for the bad look here, but that's even worse. Baidu, it closed at 89, which was perfect for us. So there's a $3 ending value. We bought it for 192, so it was a $1.08 profit. And then the Ulta came through. I got the alert. And we purchased it for 385 and sold it for 485. So pretty good week, Tyler.
All right, great to hear.
All right, what are we talking about?
Well, it's earnings season. It's been that way for maybe a week or two now, and we're right in the heat of it. And here at ORATS, we have a lot of tools and indicators that are very helpful for earnings. So, Matt, why don't you take us over to the earnings page and let's look at some stocks.
Sounds good. All right, so one of the things I like to do is just look at in the market intelligence. You can see the earnings and dividend section. So here are the earnings and here are the dividends. And so here are the number of earnings coming out this week: 54 tonight after the close, 135 either before or after on Tuesday, and so on. So it's a nice way to start to get familiarized with what's going on. Some big names clearly coming out this week. So what I'd like to do is, and we have a really good earnings section here. So the way the earnings section works is we have the historic moves, which is the dot, versus what was implied to be the move, which is the kind of the lighter colored. Red is if it went down, the stock went down after the earnings announcement. Green if it went up. And these ones that are outside, so Apple had a bunch outside on the top, meaning it ran, it went up more than expected, and only one on the downside. And then, we have some earnings and earnings per share stuff, but I think the big table is down here saying how each month of earnings in the past looked, what was implied and what actually happened. So for example, it was implied at a 3.9% move and it only moved at 1.2%. So sellers of straddles, for example, would have made money in that case when the actual is within the implied. And then we total all those up. And so the average actual move was 3.6 for all those last 12, and the average implied move was 3.9. So overall, sellers of options made money in Apple for this time. So that's the overview. Now, the question becomes, okay, well, how do you find a way to make money in this? And so I have tried a lot of different things and to varying degrees of success, but recently my mode of choice is I always like the calendars, but now I like a slight, not exact calendar. So a true calendar is selling the front month and then buying the back month at the same strike. A diagonal is when you buy a different strike, and a double diagonal is when you buy calls and puts. And the strategy that I like sells the meat kind of and buys strikes somewhat outside of those or farther out of the money, but pretty close too. You're not taking a whole lot of risk. So what I like to see are those trades, but well outside how much the stock has moved historically. So I know that's a little obtuse, but we could check. And the way that I like to do it is I set up a scan in the stock scanner to I want to find relatively liquid relative with earnings coming up. So earns, liquid, fairly valued. So, and then those are the ones I want to do it on. I don't want to do it on really cheap ones because when you think, oh, this is really inexpensive, sometimes they know things. When it's very expensive, sometimes things are going to happen. So just give me a fairly valued stock like Apple here, and we'll look for some double diagonals. So far, so good, Tyler.
Yeah, the double diagonal is a trade we've done in the past. It's one of your favorites, right? Because it's a way to get the meat, as you say, the premium from selling volatility that you expect to sort of crash after the earnings announcement. Is that right?
Yeah. Yep, exactly. And you make money because hopefully the ones that you buy go out worthless, and the ones you buy, you make money a little bit, or you could even lose money, but the ones that you sell go out worthless. So you just need to make a little bit on the one. So let's take a look at actually how this works. So as you know, our stock scanner is connected. So earnings can fairly value to our option scanner. So here is that particular stock scan. So these are the stocks that come up. So you might notice Apple was one of those. So then what we're doing is we're saying, okay, let's see this double diagonal. So how is the setup? So the setup is selling basically the front week. So the minimum days to expiration is 1, the maximum 7, and buying something farther out. And in this case, quite a bit farther out, maybe a month to 3 months. And then the deltas are quite far out of the money as well, 7 deltas to 25. So then we could take a look at what some of those resultant double diagonals are. So Qualcomm comes up again. We have rankings. I like to use our forecast because it accounts for earnings pretty well, and reward to risk and probability of profit. The distribution isn't that good because it doesn't really account for earnings that well. So Qualcomm, let's look at this one. So we're paying $2, and our risk is so the puts are 160 to 155. So that's $5. Like if it goes to zero, it's going to be worth $5 that we're going to have to pay. So we're going to lose a total of 7. The amount that extrinsically is gone. So its intrinsic is going to be 5, and we paid 2, so that's 7. So that's not good, right? Or if it goes way up to 300, it's going to be worth 10 plus the amount that we lost is 2. So we could lose $1,200 here. So that's significant. So users of the strategy are going to have to be aware of that. However, we're putting these so far out that we're hoping for it rarely to hit that area, and in most of those cases, the ones that were long are going to make up for the ones that were short. But clearly, that's if it goes way one way or way the other, that's the weakness to this strategy. What we want to do is go to 160 and stop there, or go to 205 and stop there. So now if you look at, Qualcomm, let's just say 180. So that's $20. So that's like a 12% move to the 160, and much more than that to the top, to the 205. So let's go look at Qualcomm, and let's see how often that happens. So I don't see one, or there's one that went up 12%, but that still doesn't, that still wouldn't hit this upper level. So
Yeah, a good way to visualize this could be in the trade builder as well.
yeah,
Just to sort of get a visual of how far that move is, and it looks pretty far.
yeah. I mean, look how wide that is, and then these vertical lines are the other moves. So you could, and I could go 2 years and see. So like, it's just going from here to here, here to here. There's one there to there, and this is a big move, like to go to one of these. So, in this case, this looks like a reasonable trade to take. Tyler, what do you think?
Yeah, I like it. It definitely seems highly probable to end up in the money.
All right, let's do it. Let's. So the theoreticals. This is a pretty wide market. Theoreticals 195. We usually have to give them like 3 or 4 cents. So we'll give them 5 cents here, and we'll review that order, and we'll force it, and take a picture of it. So we'll have it and send it.
Nice. So I just want to go over conceptually like the largest differences between like a straddle trade and a calendar trade, because we're talking about selling volatility. Wouldn't that be a short straddle trade? How is that different than a calendar, and why do you like calendars better?
So, all right. So a calendar. So let's compare it to a short straddle. A short straddle, you're very much betting on the stock not to move very much. In a long, you're wanting the stock to move a lot. Now, it's true in this double diagonal where we're actually paying, because there are some double diagonals where you wouldn't have to pay. But in these double diagonals where we're paying, and let's just look at a Microsoft while we're answering your question. You are simultaneous, there's a lot less risk. So the straddle in this case would be a $5 or maybe a $3 straddle here, $3.30 straddle here, and that you're short. Now, if you're short that I should say strangle. If you're short that strangle, yeah, it has to go a long way, to pass those two. But if it does, you have 1-to-1 losses after that. Whereas, in this calendar, what's usually going to happen is these are going to close out at, close to zero, we hope. And then these will still have a pretty good amount of theoretical value in them. For Microsoft, the vol won't go down a whole hell of a lot. So let's just look at that as a matter of fact.
So do you plan on closing the trade in 5 days, like right after those, short legs expire?
Yeah. So what I've done in the past is just that, you either close it right when you come in and the move has happened and you're usually up some money, or even if you're down, then you go, well, I'll just hold on to it. Like in the Baidu trade that we just closed out, we just held on to it for longer, and it went in our favor. So it's just, you just kind of look at it where your profit is versus where you think the profit should be, and then close it out then.
Got it.
So why don't we do another one? Here's a Microsoft, so we'll get at least 2 that we could look at. So Microsoft, again, you're buying 40 days, selling 5 days. It's got to go from 427 to 400. So that's got to, so it has to go down quite a bit. How much does Microsoft usually move? 3%, 4%. The biggest moves, it has a 7% here. So, that would get you near your levels, but other than that, it doesn't typically move that much. So this looks decent to me. So 247, it's 242. So we're already paying a little bit more. So let's give them a couple cents. We'll sell it for 250, or we'll buy it for 250 and force it. And we'll keep an eye on these for next week.
Nice. Yeah, I mean, speaking of, this is a double calendar, which is quite different than a single calendar. But I mean, what are the differences between those? Why not just a single calendar trade?
Well, single calendar, unless you do it right at the money, you're picking a direction.
Okay.
So let's just take a look at some of those.
So a double calendar allows you to have that tent structure that's similar to a strangle or a straddle, and but with some less risk, more protection.
Right. Well, yeah, it gives you the double tent. Now here's the Apple one. It gives you a double tent very wide. So I mean, this thing's going to have to move a lot for you to be negative.
Yeah.
And you could change. Volatility will go down. So you do have a chance of losing some money afterwards. But again, usually what's going to happen is these are going to go out worthless. And your longs are going to be, usually one of these will be, a lot more valuable. And if it goes near that's the really good thing. So again, let's look at some, other ways that we could trade this. You could, you mentioned just a regular calendar. So we'll do a call calendar, and then we'll do it, near the money, like they're talking about here. And you probably want to do shorter. So let's see if we'll come back to that. So here's a calendar. And again, here's Qualcomm, 80 cents you're paying. And so you really want it, whereas before we had profit, we had the tent going out to here and out to here. Now you're very much in this area where you want it to close, and it's probably even narrower than that because vol's going to come down pretty precipitously for this. So if it's only a calendar, you have a lot less room. I find it lot less stressful to do the double diagonals, and if you lose something and it's a big mover, you only lose end up losing a smaller amount, and usually you're scraping out $100 or something like that. So that's what I've noticed with the double diagonals. So that's one. So that's the calendar. And another strategy, like you said, you could be, a short strangle. And we'll do it for 1 week.
Maybe it could be the reward to risk.
Yeah. So now there's a lot more, there's not as much reward to risk here. So here's a short strangle. Is there any names that were? Here's the Apple short strangle. So this, as you can see, has a pretty wide profit area, but like I said, there's unlimited risk to the downside for these things. Once they get going, you're just out of luck if it goes. So I never suggest those.
Yeah, the double calendar definitely is. It's starting to look like a really good, trade. Is there any way, at the beginning you mentioned the stock scanner and how we use that to sort of filter down all the earnings stocks. Can you explain some of the indicators we use to filter those down and how we can use those to make a better trade?
Yes, definitely. So all I was after in this is just defined kind of average stocks with a fair amount of liquidity, with earnings coming up, and nothing crazy going on with those either way. I find that those are the boring stocks where you tend to do better with the double diagonal. So, and I just put the forecast earnings effect. That's just display only, but the absolute earnings move divided by the implied earnings move, I want it to be 20% up or down. I don't want it to be too much one way or too much the other. Again, for the reason that I find I want a boring stock that isn't way over or way undervalued. Just give me something in the middle, and I think I can make money with this strategy. Implied earnings move between 3 and 8. So again, don't give me anything big. 1,000 is the minimum option volume, and then the absolute earnings move that's happened. And the average over the past 12 is between 3 and 8. So they're all, again, kind of average stocks, boring but liquid. And those are the ones I want to find. Now, if you were doing a short straddle or something, you might look for different ones. But again, it's not always the case. If it's seems cheap, there's usually a reason for it. If it seems expensive, like if people are paying a lot, and if you go sell that, what I've found is they often know something, or there's a lot of uncertainty around earnings. So these are the ones that people are not as interested in, and these are the ones that I think tend to do better for a strategy like I'm doing here. And these are strategies that I like.
Yeah,
we still want them to move a fair amount, right? But we don't want them to move a crazy amount, and we are gaining from being short the way out of the money options. So. Again, I think that's the beauty of the strategy, is that you kind of win in a lot of different ways. And when you lose, you don't lose that much.
Yeah, I think it's a great strategy. And I think we have great ways of finding eligible stocks as well.
Yeah, it sure makes it convenient with all this, right? So, we always dreamed about having a stock scanner that fed into the option scanner, and the option scanner that fed into the trading analysis tool, and the analysis tool that sends straight to the brokers. And again, we have brokers, and you could even copy a trade into Schwab. You could send these to other brokers, and so it just makes it so easy to trade. And you could get alerts, and the alerts will be an event alert. You could say the number of days after earnings. So we might put alert being 1 day after earnings, just so you remember that you might have a lot of trades on, and send this out to me. So there's just makes it so much easier to trade, and a lot more fun too, because you're in a lot more control than you might have been before.
Yeah, I can't wait for us to be able to backtest these custom strategies like the double diagonal.
Yeah, that's what we're working on. So that's one of the next things we're going to do is whereas our backtester now is great, unbelievable. We have 180 million backtests in there, but it's backtesting just a
standard
strategy out there. What we want to do is, what we said to ourselves is, okay, well, let's backtest instead of just one symbol at a time. Let's backtest scanning for symbols and then doing a strategy on top of that. So that is going to be a lot of fun, and we're getting closer on that, Tyler.
Yeah, I can't wait. I mean, it's going to replicate the user experience so much better.
Yeah, I agree.
Well, I think that's about it for today's show. Unless you have anything else, Matt, I think that was a good trade. You showed the scanners off really well, and it's just double diagonal. I love it. I think that's a great trade. It's one of your favorites, I know.
Yeah, and then you should, and then you should go check, just about how the trading has been. And you brought up a good point about looking at the trade builder to see from a technical standpoint, history standpoint, how much a stock would have to move for you to lose money. So there's just a wealth of knowledge in here that you could easily put into your workflow to do well in this strategy, Tyler.
Yeah, it's really great. All right, thank you, Matt, and thank you, Trader. We'll be back next week with another show. If you guys have any questions, you can email us at support@orats.com. Or if you're a user of the ORATS platform, please leave your feedback and any questions in the community tab. Helps everyone else learn and everybody engage with each other. And we're trying to involve that more. So we'll see you guys again next week.
Thanks, Tyler.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.